I really had a look around and I thought, look, I'm supposed to be the growth guy, so I'm going to try and find you a good growth stock that has been beaten up with the rest of them. So
that can't be too hard, can it?
Well, here's an elevator pitch for buying Twilio. And I guess I'm mad to be suggesting this. A huge loss-making growth stock that's down 67.5% at the time of recording year to date, and that means it's about 80% off its highs last year. Here goes. So Twilio is a $15 billion tech company. It's in the comms sector primarily. So the best way to think of it is like an app store for developers, rather than build features like text messaging and alerts, voice calls, videos, authentication alerts, and things like that. Much in the same way we talked about Cadence selling IP blocks. That's kind of similar how Twilio's API works. Save time to build the bespoke things that your app needs and not reinvent the wheel. So its customers, they're companies like Airbnb, Lyft, Stripe, Marks and Spencer's in the UK, Steve, Deliveroo, Chime Bank. It handles about 10 trillion API events a year and sends out about 1.3 trillion emails. Oh. So it's big. Its business model is focused on usage-based billing, so it allows a customer to pay for the actual amount of Twilio services they use. It doesn't get bogged down having to estimate what they'll use and then getting caught out and having to up the packages. There's none of that with Twilio. It's a literally pay-as-you-play kind of deal. In terms of figures, Twilio's growing pretty quickly. If you head back to 2018, Twilio had about 650 million in annual revenue. You're looking at it at its last reported figures, the end of 2021. We're 4.5 times that now. In the last reported quarter, Twilio announced revenue had grown 48% year on year, and that was despite some pretty tough comps. That quarter alone was 861.6 million, so essentially 210 million more than just 5 years previous would have been in the full year. So Twilio's share count is one of the things that people would point you to. It's doubled. And actually, that rate looks to be slowing at the moment. So we've 4.5x revenue. We've doubled the share count. That's more revenue per share. Twilio's got about 5.35 billion in cash at the moment. Only 1.2 billion in debt. So there's room here for Twilio to make some cash and stock moves, definitely. Dollar-based net expansion rate, DABNA, we quite like this one, don't we, Steve? 127%. So nice. Looks to me like they're pretty good at landing and expanding. So look, this is a cash tomorrow kind of stock. So how do we value it? And the answer is, I don't know. It's a tricky business and it's got a lot of fast-moving parts. But in the absence of me giving you some figures, here are some metrics that are correct at the moment. So its price to sales is about 4.84. That's as cheap as it has ever been. That's cheaper than it IPO'd. Enterprise value to sales, 3.68. Price to gross profit is about 10. So, I mean, they're the ones that jump out to me as indicating that it's at least as cheap as it has ever been. So stock-based comp here is going to be your earnings killer for the foreseeable future. Although the CEO, Jeff Lawson, recently hinted at the end of the last report that in 2023 he's going to look to start cutting costs and actually pivoting to earnings. He was talking about non-GAAP profitability, something that Twilio doesn't really concern itself with. So look, I want Twilio to be as big as possible when it pivots to profitability. It's not a cash-intensive business, so it's in the interests of shareholders for it to spend that money wisely, broaden the service offering. More revenue in the future equals more cash flow in the future when they eventually do pivot. So look, now for me seems as good a time as ever to get your hands on some Twilio. I mean, we know it's a mature company. We know it's beating expectations. It could be at a semblance of value. Of course, when we compare it historically, I think potentially we've got a bit of, throwing the baby out with the bathwater scenario in tech here. Is it something that jumps out at you, Steve?
I love this area to be looking through. I love the fact that this is unprofitable. Every time I look on CNBC, someone's busy telling me about buy tech. Tech is beaten down. Not the unprofitable stuff. That's all garbage. Buy the profitable tech stuff. Buy anything ranging between sort of roughly Apple, Salesforce, IBM, Microsoft, that kind of obvious tech. which tells me that the place I should be looking is in the unobvious tech, in the stuff that is currently loss-making because everyone's busy running into the stuff that has strong cash flows. We're still cash flow negative then at Twilio. I was just having a look at that. And I'm okay with that thought for the time being. The thing that I think you need to tread a little bit carefully around with this kind of business, you kind of touched on it, but it jumped out at me, was I'm fine with loss-making stuff as long as we're not about to run out of money in this environment too much. And that's going to be a theme coming back to me a little bit later. So I like this as a kind of, it's a sort of rule breaker over rule breaker thing in a certain way. You're supposed to buy stocks that have been winning. The business has been winning reasonably well, but the stock hasn't. The stock is down a long way, as you mentioned. It runs a pay-as-you-play model, which is interestingly contrarian to my ears. When I think of this, I think, isn't everyone supposed to be talking about subscription revenue all over the place, which is basically the opposite of pay-as-you-play, right?
Yeah, and Snowflake run the pay-as-you-play model as well. So this is a model that is coming to a little bit of prominence, I guess. It's an interesting model. For me, it says, look, we've got supreme confidence that our product is of value to you. If they can give you the API and you don't actually have to pay a cent for it unless you use it, then what's the incentive to not try it? Do you know what I mean? I guess that's Twilio's idea. Go on, try it.
Yeah.
See if you can build anything better, because for a lot of these things, they're kind of mundane kind of services that, would take time to build and have very little return. Especially for somebody who, just isn't, if it's an authentication alert, then what benefit do you get out of sending that? You may as well just buy the service in, get somebody else to send it, and don't waste your time on it. So yeah, I think Twilio's in a really interesting sort of sector, and I can't see a reason why people wouldn't try it.
Yeah, it's shifted sentiment a little bit lately, hasn't it? From thinking this doesn't have a PE ratio because it's unprofitable, therefore I can pay whatever I like for it because I'm not buying it at a massive PE. There isn't one. This thing doesn't have a PE ratio, therefore I'm not willing to pay anything at all for it. And the truth is probably somewhere in the middle, to be honest. There's some stuff that doesn't have PE ratios that's probably terrible, and some stuff that doesn't have PE ratios that's probably great. And Twilio, when you have a look at it, or I was just looking at numbers very sort of briefly, you're looking at gross margins between sort of 40-50%. If you imagine that gets divided in half, this is guesswork, right? But to me, something 20-25% net margin when this business is at scale and profitable, bearing in mind the kind of business it is, where it gets its money from, the fact that it is reasonably cost efficient, or I would expect it to be, and reasonably well insulated from inflation. It looks to me like you get something like 4.84 times sales, 20-25% margin, maybe times it by about 4 or 5, then, and you're going to be around a 20 PE for a company that's growing like an absolute weed. Sure, you will need to discount that back because that cash will come to you later rather than sooner, and you will want to factor that in, but 20 times earnings for something growing pretty strongly, that would be the way I would think about valuing this. I would build in a bit more for the uncertainty because I haven't seen it put up a 25% profit margin yet. I haven't seen it put up any profit margin at all. But that's the way I'd be thinking about this kind of thing, I think.
Yeah, and I guess just to build on that point, one of the things with Twilio is that, if you were putting this into a DCF calculator and you were saying in 10 years' time this is going to grow at 5%, with a 5 billion cash pile in their hand, and they do enjoy making acquisitions of small, fast-growing, little companies that they just sellotape onto their API. I mean, growth in this company could be Salesforce-like, where you're talking 20 years at 20%. Do you know what I mean? So when they do pivot to profitability, if that is in 2023, if you believe that's to be the case, if you was to factor in 20 years of decent growth from that period onwards, you're talking about a big company here, a big company with big profit margins. Now, of course, the opposite to that argument is that, somebody comes and steals the pudding. But I don't see that at the moment. I don't see where the threat, the really big competition is.
No, the bigger threat to me, you said this is at about 15 billion, did you say, market cap?
Yeah. Yeah.
It looks to me like if I wasn't constantly worried about antitrust in various things, it might be stealable by somebody, and I would be worried in this stock if I paid whatever the high was for it, so 80+% more than this. I'd be currently thinking there's a real danger that I get more or less stopped out of this below the level I paid for it. So someone buys it off us at, I don't know, a 15-20% premium, even a 50% premium, but I'm still going to end up locking in a loss. But at these levels, the worst thing that happens to you is you get bought out at a premium. Well, that could be a lot worse. There's people currently running after deals where someone's getting bought out at a premium in stuff like Activision Blizzard.
If this was a UK stock, it would have already been bought.
ARM is coming to the UK, from what I understand of it, which is interesting, and we'll see how that goes.